What can we expect from central banks and particularly from the Fed? Well, the key thing to read about today's FOMC meeting is the expectations of inflation added to the expectations of growth. Wage growth and unemployment data, those are working well in line with the expectations of the Federal Reserve. However, it is quite likely that what the Federal Reserve will do is to downgrade growth estimates for 2019, be a little bit more optimistic about 2020, and downgrade quite significantly inflation expectations. And this is the key factor. By downgrading key inflation expectations, but remaining relatively optimistic about the job market and relatively optimistic about the overall economy, what the Fed is trying to do is to say that it will continue to be dovish, however, not aggressively dovish. And what it is likely to try to tell us is that the flattening of the yield curve is not to be thought of as a sign of an incoming recession, but the management of the cycle and the management of the curve by the Federal Reserve itself. Therefore, what can we expect? Central banks are going to continue to be dovish. Central banks will continue to be positive about liquidity injections and keep very, very low rates. However, the macro data continues to be weak and it is not likely to change its trend just because of liquidity injections, because the problem is not about liquidity and neither of low interest rates. Therefore, what we need to do is to keep a very prudent approach to very aggressive high beta exposure. And what we need to be is aware that we have already seen a big jump, a big bounce in equities, in risky assets due to the liquidity injections, and that those are not going to continue to grow dramatically from here onwards. Therefore, let us be a little bit more prudent. Let's pay a little bit of respect to the real data, earnings, cash flow guidance, and macro data, and be aware but not disguise risk with liquidity.